Okay, the remaining 20 is called the future taxable amounts. We don't pay tax right now, but we will pay tax in the future. Okay, so because this is timing, this is just temporary differences, not a permanent differences, right? It's just timing issues. We don't pay it right now, but it should be paid. Tax should be paid in the future. Okay, so we call that 20. This 20 is called the future taxable amounts. So let's say future tax rate is also 20%. Then 20 times 20%, that will be our tax liability. Okay, but this tax liability is going to be in the future. Okay, so 80 times 20% is a tax liability. It's due right now, right? Due recently, okay, in a couple of months. But then the future taxable amount times 20%, that tax liability will be due in the future. Okay, we call that deferred tax liabilities. So in this case, we have two liabilities. One is called income tax payable, right? This is the income tax payable. This is what this is called the deferred tax liabilities. Okay, and then we talk about this when we write the journals. Remember, we always write, recognize income tax payable for example, like this, right? So we recognize income tax payable, and then recognize deferred tax liability, and then this income tax expenses always the balance. Okay, this is the one journal, right? So that 56 should be, in this case, should be a total 40 plus 16. Okay, so that's how we get income tax expenses. So once we have income tax expenses, let me go back to this beginning. So we have, this is just an example of our income statement, right? So we talk about that income tax expenses, okay? This 80s, okay? That's how we get this $80,000 in reality. Okay, so when we learn talk about when we in the in 121A, so we always talk about the income tax expenses should be, let's say, let's 40% times income before income taxes, right? So like 40% times the 200, but actually it's not that the case. Okay, that's just a very naive case. Okay, so we don't do like that actually. So now we're learning how to figure it out the income tax expenses, okay, correctly. That makes sense? So remember, income tax expenses always the balance when you write the journals like this, right? So remember that journals, this 56 is the balance in that journal. So this is what we learned. And we talk about this situation, right? Accounting income is greater than taxable income. And then there's two kind of situation. Okay, let me go to that summary, this one. Two situation, the accounting income is greater than taxable income. One is this, right? One is this issues, one is here, okay? Here, with this part, we talk about the revenue, right? So this is the revenue. Look at the revenue will be recognized in accounting, but will be postponed on tax return. That's why right now you can see that in accounting, we're going to report relatively more revenues than tax. That's why accounting income is greater than taxable income. Okay, so that's the one situation. And we had example, right? We talked about this installment sales, right? So this second situation, you're going to see that later. Okay, so and then the second situation regarding this is this, right? So this is called the expenses issues here. So those expenses reported on tax return right now, okay, but it's in the income statement later, because reported tax return right now, tax return gonna deduct more items, right? More amounts, okay? So that makes tax return, the taxable income is less than accounting income, okay? So both situation, you can see accounting income is greater than taxable income, right? So and then that's why we have those called the future taxable amount. Some amount won't be taxed right now, okay, but will be taxed in the future. And then you have liabilities, right? We call the deferred tax liabilities. Okay, so those two situations, right? So you can see those purple colors here are the one we call the deferred tax liability issues. Okay, today we're gonna work on the other issues, right? So this is which is this, right? So those colors. Okay, so let me with this. Okay, we call that deferred tax asset issues. So if you look at deferred tax asset, what happens? Let me go back to this initially here, right? So let's talk about these issues here, right? This part, okay? So accounting income is less than taxable income. Let's say accounting income is 100, right? But taxable income is 120, okay? Accounting income is 100, taxable income is 120. Looks like not fair, right? Because what? In this case, you can see our profit, okay? We only made profit 100, but why we're gonna be taxed on 120, right? So it's not fair, okay? But remember that this difference is only a temporary difference, okay? It's only temporary. So right now you pay more tax, right? But in the future you don't have to pay that much tax, okay? So you can see that 120, subtract 100, then you paid more tax on that 20, right? More tax on the 20. So in the future, you don't pay tax on 20. Okay, let's say this year, right? Let's say next year you made a profit 100, right? Then you don't pay tax on 20. You only pay tax, you minus 20, you only pay tax on 80. Okay, so let's say tax rate is 40%, then 80 times 40%, that will be the tax you're gonna pay. Okay, so we call that 20 here. 20 here is called a future deductible amount. In the future, you can deduct. Okay, when you make profit like this, next year you made profit 100, you can deduct this 20. Okay, you don't need to pay tax again, right? Because you paid already. So the taxable income next year will be 80 only. Okay, so we call that again. We call this 20 is a future deductible amount. Okay, you can deduct in the future, deduct that amount because you pay tax already. So, and let's say future tax rate is 40%, right? So then the 20 here times 20 times 40%, you got the 8, right? You got 8. So that 8 is so-called deferred tax assets. Okay, deferred tax asset. So 8, why you call it deferred tax asset? Remember, 8 here is what? Is the future benefits, right? The 8 is the future benefit because in the future you can recognize this benefit. You don't have to pay tax because you paid already, right? So in the future you save our tax. Okay, that's the tax benefits, right? So this is 8 here is the benefit, is the future benefit, and by definition, future benefit should be called assets, right? That should be one of the assets. So deferred tax asset is one of the assets. Okay, one of the assets accounts. Okay, it's called the deferred tax assets. Okay, so that's the deferred tax asset situation. Anyone, any questions so far? If you have a question, you can just unmute yourself and then you can ask question. Okay. Any question at this moment?
So I have a question.
Yes, go ahead.
So the 40% is just imaginary percentage that you're putting?
Yeah. Yes, okay. yes. I just gave you example 40%.
Okay.
So it could be in reality, it could be 30%, could be 20%, right? So yes.
All right. Thank you.
You're welcome. Any other question? Yeah, if not, then let's take a look at example. Okay, let's take a look at the example. So again, remember this the situation. We talk about the initial year. Okay, remember, keep in mind, we talk about accounting income greater than taxable income or accounting income less than taxable income. We talk about we're talking about the initial year. Okay, what happens? So so then let me go to this. Show you. Okay, let me go to this summary first. Okay, then we can talk about those details. So look at this summary. Okay, we talked about those two situations already, right? So in this two situations, so those accounting income is greater than taxable income. That's why we have a future taxable amounts, right? So then we have deferred tax liabilities. But now we talk about these two situations, right? Those two situations. Okay, so those two situations is what? It's the accounting income is less than taxable income. Okay, so relatively in the first year or in the initial year, we paid more taxes. Okay, paid more taxes. So then also you have those situations either on the revenue side, right? So this is the revenue, right? Those revenue was reported on tax return, okay, but going to be reported in the income statement later. Okay, in accounting, we're going to recognize those later. And how about this part here? Those about the expenses. Those expenses will be reported in the accounting right now. Okay, but will be reported in the tax return later. Okay, so that's results. Those two situations are going to result our our accounting income is less than taxable income. Okay, so taxable income less than, greater than accounting income. Relatively, we're going to pay more tax right now, right? But we will have a future deductible amounts, and that's going to result a future those the future benefits, right? We call it deferred tax assets. So let's look at those. Let's look at those two examples, okay, regarding those two situations. Okay, so let me go skip this part. This is the accounting income is greater than taxable income situation, right? We talked about last time. Okay, so again, we talk about today. We talk about the deferred tax assets. Okay, deferred tax asset situation. Okay, this situation. Um, so so here we talk about those are two situation, right? The one we just saw, I just saw. So let's look at this example. This is the first one. This company reported pre-tax accounting income in those 3 years, 120, 120, 100, and 100. Okay. So 2021 income statement include an 80 millions. This is special, right? So we have those pre-tax accounting income, okay? But now we have this in 2021, it said that the income statement include an 80 millions warranty expenses, okay? Warranty expenses. That is deducted for tax purpose when paid, okay? We paid in 2022 36 and 2023 44. Okay, so if you look at this situation, what do we have here? We have this pre-tax accounting income, right? So we have those three pre-tax accounting 120, 100, 100. Okay, so that's given. And in that in 2021, so we have a special expense which is $80 million. It's warranty expenses. First of all, we need to understand what is warranty expenses, right? So warranty expenses happens, let's say, let's say we sold our car, right? We sold the car, the car always have a warranty, right? So when something wrong with the car, customer always can bring back, right? So usually we give a car warranty like for 3 years, right? With anything, within 3 years, something wrong with the car, so then the customer can bring back, and then we fix it for free. Okay, so that's gonna be additional cost for us, right? So we call that warranty expenses. Okay, so in accounting, how to recognize warranty expenses? You remember we need to follow matching principles, right? We need to recognize the warranty expenses in the same time when we recognize our revenue. Okay, so in this case, in 2021, we sold our car, for example. Okay, so then we should recognize those warranty expenses in the year of 2021 to match the revenues. Okay, so then how to do that? Because warranty expenses, it may not happen in this year, right? So then we need to predict, right? We need to estimate the warranty expenses, right? To make a prediction. Okay, in this case, we predict. So $80 million will be warranty expenses. Okay, so we write that adjusting journals. Remember that in accounting, what do we do? We write adjusting journal. We debit warranty expenses for 80s, right? So this is 2021. Then we credit, this is the warranty liabilities for 80s, right? So that should be the journal, adjusting journals. Okay, this is the one of the adjusting journal. And then when actually happened, let's say 2022, so we actually use 36, right? So customer bring back, then we spend 36 millions to fix it. What do we do? So we have all of the cost, right? So then, we should credit, for example, credit cash, for 36, we should debit this warranty liabilities for 36. Okay, so similarly for 2023, we should debit warranty liability for 44, and then we credit cash or whatever, right? So those materials, right? So we spend, okay, to fix it. Then for that we credit those whatever those accounts 44. Okay, so this is accounting, right? Accounting. This is how we deal with the warranty expenses. But tax. Okay, so that's why 80 was included, right, in one of the it was included in as one of the expenses. That's how we get this 120. Okay, 120. So before 80, it should be 200, right? So if you want to exclude 80, then accounting income exclude the warranty expenses should be 200. Okay, so how about the tax? Tax purpose, how to do with tax. Tax law is different, right? Remember, tax law is different. Tax law won't allow us to deduct 80s, okay? Because we haven't spent, the cash yet or make any payments yet, okay? So they won't allow us to deduct 80 millions, okay? They only allow deduct those ones when we actually make payments, okay? Let's say, here we paid in 2022 and 2023. That's the time we need to actually deduct. Okay, so in this case, again, warranty expense in accounting, we recognize 80, right? So in the year 2021. Okay, how about the tax? Tax, you're not allowed to recognize any warranty expense or we call it warranty deductions in the year 2021 because nothing happened yet. It's not, remember, the tax basis tax is usually the cash basis. Okay, so that's why we're not allowed. Okay, so you only can deduct 36, right, in 2022 and 44 in 2023. Okay, so that's the difference between accounting and the tax is what? It's the 80s, right? We talk about the initial year. Okay, initial year, the difference is the 80s. Okay, between accounting income and taxable income. So what is taxable income? It should be what? We're not allowed to deduct 80s. So this taxable income should be 200. That makes sense, everyone? Taxable income is 200. Accounting income is 120 for the year 2021. How about the year 2022? For year 2022, you can see, now tax we allow to deduct 36. Okay, so then the total differences become from 80s now decreased by 36, right? Decreased by 36. Okay, so and then because we allowed to deduct 36, then accounting income is 100. Now we deduct additional 36, right? So then taxable income should be 64. 2023, similarly, right? So it was now we're allowed to deduct additional 44, right? So then our taxable income is only 56. Makes sense, everyone, about this story? Any questions regarding this? We need to, so this chapter a little hard because we need to understand the accounting, treatment, right? So for those issues, like for example, this issue, the warranty issues, what is accounting, the rules about accounting, right? And what is rules about the tax? Okay, we need to understand this part. That's the first thing we need to understand. Looks good, everyone. You don't have questions, then okay, now let's move on. Okay, so let's talk about the year 2021. Okay, so the first year of 2021. So if you look at the year 2021, so this is taxable income, this is accounting income, right? So then let's based on the taxable income, then we owe tax, right? So right now, okay, so look at this, right? Taxable income is 200, right? Accounting income is 100. And of course, the difference is 80, okay? So now 200 times 25, that's how we got the 50, okay? So this is the what? This is 200 times 25%, okay? So we got 50, okay? We got 50. So 50 should be what? Should be the income tax payable, right? So now we need to pay tax, okay? At last time we talked about the corporation need to pay tax by March 15, right? So that's the current liability, we call the income tax payable, okay? So we have this current liability, right? We credit income tax payable for 50, okay? Um, so that's based on our taxable income. Then let's look at the differences between accounting income and taxable income, right? So this is the 80, okay? 80 is what will be our future deductible amount because we paid more taxes, right? In the future, we can deduct, okay? How to deduct? So we talk about, in 2022, we can deduct 36. In 2023, we're going to deduct 44, okay? Total future deductible amount is 80. Okay, so future deductible amount times 20, let's say future tax rate is also 25, 80 times 25, that will be the deferred tax assets. That will be our future benefits. Okay, so then deferred tax assets should have a 20 balance. So let's say beginning balance 0. How to make it become 20? We should debit, right? We should debit this accounts by 20. That's how we get this debit deferred tax assets. Okay, and then what is the last item? That income tax expenses. Okay, remember income tax expenses always the balance. Okay, for this journal. Okay, to match this journal. Okay, so that's how we get the income tax expenses. So it is. Okay, so this is a year for the year of 2021. Okay, 21. Any question at this moment? No, let's talk about 2022. So 2022, we know pre-tax accounting on 100, right? So then taxable income is 64, right? Because what we're gonna deduct, we're allowed to deduct that 36, okay? So it's because we actually spent $36 million, right, in that year. So so then taxable income is only 64. Okay, so now 64, let's say tax rate is 25, 64 times 25, you got 16, right? So 16 should be the tax we owe right now, right? We call it income tax payable. Okay, so then how about the future deductible amounts? Remember, future deductible amount was 80, right? So now the decrease, right? The total difference decreased by 36. Now you still only have 44, right? So 44 should be the future deductible amount. You're going to deduct in year 2023. Okay, so then total future deductible amount 44, then you times 25%, that gives you 11. 11 should be the balance of the deferred tax assets. Okay, that will be the total future benefit right now. Okay, so then beginning balance was 20. How to make it become 11? You need to credit 9, right, to this accounts. So let's see this, right? Credit 9 to deferred tax assets. Okay, and then what is last item in the journal should be the income tax expenses. It should be the balance. Okay, in this case, it's a total. So that's the 2022. Okay, how about 2023? So will be similarly, right? So now taxable income, accounting income is 100. Taxable income, you can deduct 44, right? Because you actually spent 44, right? So now you are allowed to deduct. So taxable income is 56 right now. Okay, 56 times 25%, you got that 14. Okay, 14 should be the tax we owe right now, which is the income tax payable. Okay, how about the future deductible amounts? Remember, you already deduct, right, those 2 years. Okay, so no, you don't have any future deductible amounts anymore, right? So that's why the balance of this deferred tax assets should be 0. But it was 11, right, before this. So how to make it become 0? you need to credit 11 to make it become 0. That's how we get this credit to deferred tax assets. And then the last item in the journal should be the income tax expenses.
Can you go back to the first entry?
Okay, the 2021.
Yeah, I'm a little confused.
Okay, yes, go ahead.
The future deductible amounts to 80. That is from the current year warranty expense.
Yeah. So yes, because that's 80s. Yes.
So it's not adding the 36 and the 44.
Yeah. So you add those two, that will be 80s. It just give you details. Okay. In this case, just give you the details. What happened when you're gonna deduct. Okay. So the total difference. This is the 80s total differences, right? Which will be our future deductible amounts. Okay, and then if you want to look at the details, when you're gonna deduct, right? So in 2022, you can deduct 36. 2023, you're gonna deduct 44. Just give you more details.
Okay.
That makes sense. Any other questions about this example? Any questions about this example? So those are the 3 years. Okay. And then if you look at deferred tax asset initially, right? So it was 20, right? Remember initially it was 20 because total future deductible amount is 80s, right? So it was 20. Okay. So then the 2022 gonna decrease by 9, 23 decrease by 11, and then by the end it's gonna be 0. Okay. That's why we said this is the temporary differences. Okay, over 3 years, no more differences. Total account income going to be same with total taxable income. It's just the timing issues. Okay, that's why I call it temporary differences. So this is the revenues related. Okay, so let me see if we can do a little practice. Okay, so let me share the let me share you with another one. Do you see this one right now? The exercise questions?
No.
Not really. Okay, let me do that again. Oh, here. Okay, can you see that? Exercise 16-7.
Yeah, we can see it now.
Okay, so yeah, let's work on this 16-7. Okay, so let's just practice this part. So this question is not start from the initial year, right? Okay, it starts from the, in the middle, okay? So you already have that situation. We talk about warranty expenses, right? So you already have those deferred tax assets, right? So then that's why we said deferred tax asset is what? Is yeah, so it's deferred tax assets have the balance, right? So that's for $35,000. Okay, so that's given, right? So it's coming from the previous years. Okay, so then you talk about this year. What are we gonna do, right? So what we're gonna do is you want to calculate what is the balance in this account, right? What is the balance? Okay, so you need to calculate what is the balance in this deferred tax assets. So you want to look at what is the balance of your future deductible amounts, right? Which is what the total differences between accounting income and taxable income. So what's the total difference between accounting income and taxable income? What do you think?
2 million.
Yes, exactly. 2 million is the total differences, right? Because this is what? This is the warranty liabilities. Remember, those liability will not be able to it will not be able to deduct, right? It was recognized in accounting, right, as expense. Remember, when we debit warranty expenses, you need to credit warranty liabilities, right? So then, when you collect payment, you decrease liabilities, okay? Just like, the future deductible amount is going to decrease, okay? That's why your total future deductible amounts at this moment, by the end of this year, should be 2 millions, okay? That's the total differences between accounting income and taxable income. And then you want to times what? Let's say the tax rate is 25%, right? So 2 million times 25%. Okay, so that's how we get this $500,000. That makes sense? Okay, and then how to make it become, it was 435, how to make it become 500. So you need to what? You need to debit the differences, right? 65,000, okay? And then you can write a journal, right? You can write a journal. You need to debit to this account. You need to credit income tax payable, right? Income tax payable. Okay. And income tax expenses will be the balance. Have you finished the journal? You done with the journal?
Yes.
Okay, so now let's write the journal together. Okay, so we will talk about we need to debit deferred tax assets, right? So it's a debit. This is a journal with debit deferred tax assets for $65,000, right? And then we should credit the income tax payable, right? Income tax payable for how much? So this one, because income tax, if you look at this, taxable income is 75, right? 75 times 25%. That's how we get this $18,750,000. Okay, so that should be the income tax payable, right? Taxable income times 25%, 75 million times 25%. So we have a one credit, one debit. Then to, this is one journal, right? So the last item is the income tax expense, right? Income tax expense, you should debit. So the differences, okay, the difference between these two will be $18,685,000. Okay, so that should be income tax expenses. That makes sense, everyone? Any questions at this moment?
How to get the 1875 again?
Can you speak a little louder? Or maybe let me. Wait. Maybe Yeah. Can you speak a little louder? Okay. Go ahead. Yeah.
How to get the income tax payable then?
Income tax payable is based on this taxable income. See, the taxable income is 75, right? 75, right? 75, tax rate is 25%. 75, this is 75 millions times 25%. That's the income tax payable.
Okay.
Yeah, taxable income means you need to pay tax on that, right? On the 75, okay? You pay 25% of, 75. Any other question? Okay, so this example, just this question is just like in the middle, right? So we not start from not like the whole. Let me go back to that. Back to the PowerPoints. Not like the PowerPoints, right? PowerPoints, you start from the beginning, right? Oh wait, what happened? Okay. PowerPoints, you start with beginning, but now this is not, right? Not the start with beginning. It's like a jump in the middle. Let me go back to this. Okay, so that was the warranty expenses. That's the expenses situation. So now let's talk about another situation called the revenue, right? So those revenue related, okay, revenue related deferred tax assets. So look at this example. So this company publications, okay, so reported pre-tax accounting income 100,000 in those 3 years. So every year it's just 100,000. Okay, just make it simple. And then 2021 income statement does not include. Okay, so that $80,000 of magazine subscription received that year. So this subscription is for 1 year or 2 years, okay, subscription. So you receive those $80,000 magazine subscription. So we are the what? We receive those one. Those $80,000 will become our revenue, but not right now, right? Because we call that deferred revenues, right? Deferred revenue, deferred magazine subscription revenues. Okay, so when we receive those one in accounting, all we do is that we receive cash, right? We debit cash, $80,000. We credit deferred magazine subscription revenues for $80,000. Deferred revenue is one of the liabilities, right? So then when you actually, then you're gonna recognize those revenue over a period of time, right? Over 1 year or 2 years. Okay, remember this is accounting, right? So that's how we deal with this, in accounting. Okay, so okay, so subscription revenue. Okay, so subscription revenue if you look at subscription revenue related to the 80 millions, we don't recognize any revenues in the year 2021, right? So instead, we recognize those deferred revenues, okay, which is one of the liabilities. And then you recognize those revenue when you over a period of time, right? So in the year 2022, you recognize 60, 2023, you recognize 20. Okay, that makes sense, everyone? About this is accounting, right? So that's how we deal with these advance payments, okay? We talk about that, right? So advance payments situation in the liability, the short-term liabilities chapter, right? So how about the tax? How about the tax? Tax law said, because you already received that $80,000, you should need to pay tax right now. Okay, so that should be added, right? So to the taxable income. That's why you should pay tax that 80s, okay? Because you receive cash payments already. Okay, remember tax law most likely are the cash basis. So that's why what is taxable income? You should not only pay on 100, you also pay on 80s, right? So total taxable income is 180 in the year 2021. Okay, it should be 180. Okay, that makes sense. So 180 minus 100, you can see that 80 is what is the temporary differences. We call the future deductible amounts. Okay, future deductible amounts. In the future, in 2022, now you can see we can deduct, right? So you can deduct 60. Okay, so accounting of the 100, now you deduct 60. So that's why taxable income is 40. And how about 2023? You can deduct another 20. Okay, so then our taxable income is 80. Okay, 100 minus 20. Okay, you only pay tax on 80. Okay, you can pay less tax. In this case, tax will be paid earlier, right? So that's why this 180, right? So you pay more taxes in the year 2021, so that you can pay less taxes, right, in the 2022 and 23. Okay, but no matter what, total accounting income, right? Total taxable income, total accounting income are the same. Okay, it's just the timing differences. Over 3 years, they're exactly the same. Okay, that's why this is the temporary differences. Makes sense, everyone? Any question about this this situation in accounting? How to deal with that in accounting and in the tax? Yeah, if not, then let's work on that. Let's do the journals, right? Let's analyze 2021. Remember 2021. So this is 180 is a taxable income, right? So then let's say tax rate is 25%. You times 25%. That's how we get 45. 45 should be what? Should be the tax we owe right now, right? We should pay tax on 180. Okay, everyone's okay, right? So taxable income. So that's because we need to pay tax on 180. Okay. So tax rate is 25%. 180 times 25, you got 45. 45 should be the tax we owe right now, which is going to be due in a couple of months. Okay, so we have the income tax payable 45. Okay, and then what is the future deductible amounts? Remember that that's the 80s, right? So the differences between accounting income and taxable income. Okay. So 80 should be the future deductible amounts, that's 80, okay? And if you look at the details, when you're gonna deduct, you're gonna deduct in 2022, 60, right? You can deduct 2023, 20, okay? So total future deduct amount is 80. So now 80 times 25%, let's say tax rate is 25% in the future. So then you got 20. 20 should be the total benefits, okay? Future benefits, okay? Which is the one of the assets. We call it deferred tax assets. So deferred tax assets, the balance should be 20, okay, at the end of this 2021. Okay. At the end of 2020, let me say that again. At the end of 2021, so deferred tax asset should have $20. 20,000, right? The balance. Okay. So then it would beginning balance was 0. How to make it become 20? Then we need to debit, right? We need to debit to this accounts. That's why we have this, right? We debit this accounts, okay, for 20. And then the last item in the journals is income tax expenses, always the balance. Okay, so this is the year 2021. Question at this moment? Okay, if not, let's talk about 2022, right? 2022, we're allowed to deduct, right? We're allowed to deduct that 60, okay? So then that's why taxable income is only 40. Okay, we only pay tax on 40, okay? Because we already paid, right? We paid more, paid 80, right? So now we are allowed to deduct, we pay less tax, okay? So 40 should be the taxable income. When you pay tax on 40, tax rate is 25%, 25 times 40, so you got 10, right? 10 is the tax will be due right now, right? So this is income tax payable, 10. Okay, so how about the future deductible amount? It was 80, right? So now it decreased by 60. So that's why we have 20, right? That 20 will be deducted next year, right? In the year 2023. Okay, so 20, now 20 is the future deductible amount. You times 25%, you got 5. So 5 should be the total future benefits, okay? Which is our deferred tax assets. So it was 20, right? At the beginning of the year. So now it should be 5. How to make it become 5? You need to credit 15, right? That's how we get this credit, 15 to deferred tax assets, the journals. So now you have to credit. The debit is what? Income tax expenses, always, right? So it's the total in this case. This is 2022.
Professor?
Yes, go ahead.
Why this time, when we go to 2022, the deferred tax assets will be turned to credit, is not debit?
Because you see that what we're trying to calculate, let me read this part. We calculate what is the future deductible amount at the end of 2022. You okay, right? Right? So this is the future deductible amount by the end of 2021 was 80s. Okay, now you already deduct 60, right? So that's why future deductible amount now become 20. Okay, and 20 times 25, so you got 5. 5 should be the balance of this deferred tax assets. That should be the total benefits, okay, of this tax issues. Okay, it's deferred tax assets. So it was 20, right? But 20 is come from the previous year, right? You look at the previous year, we had that 20s. Remember that, right? So we have this 20s, okay? So now this is the end of the first year, okay, which is the beginning of the second year. So now this is the second year. So it was 20 at the beginning, right? So at the end of the second year, it should be 5. So how to make it become 5? You have to credit, right? To make it become 5. Okay, that's how we get this credit to these accounts.
Why can't we just multiply the revenue recognized in the current year by the tax rate?
Revenue recognized, but
the 60,000 that we recognized in 2022. Why can't we just multiply that by the tax rate, and that would be the credit? The credit.
Oh, I see. Okay, so you said okay. So
why do we multiply?
I got it. Yeah, I got your question. So instead of do like this, you can say the 15 equals 60 times 25%, right?
Correct.
Yeah. So that's what. Yeah. In this situation, this is okay. Okay, because this is a very simple situation. Remember, this is where the starting point. Okay, these chapters. So you can do like that. You can still get the same results. Okay, but not today. Okay, so on Wednesday we're going to talk about more complicated issues. Okay, so this approach doesn't work. Okay, don't do that. You're gonna make mistake on this situation.
So in general, you want us to subtract the recognized.
Yeah, exactly. Do what I show you. Okay, so figure out the balance, and then this one is try to make it become the balance. Okay, that's how we get the 15.
Got it.
Make sense, everyone? Remember we have, let me go back, let me see that again. So we have the 20s, right? So this 20 comes from the previous years, right? Or the beginning of this year. So you need to figure out by the end of the year, what is the balance? In this case, of 5. So now how to make it become 5? Then that's why we have credit 50. Okay, so don't go to use that 60 times 25. Okay, for this question it's okay, but you're gonna see that next time. Okay, so this approach it doesn't work. Okay. Any other questions? But that's good stuff. Okay, so but yeah, we cannot that's not a correct approach. Okay. Any other question at this moment? And then 2023 similarly, right? So we have pre-tax accounting on 100. Now taxable now we allowed to deduct that 20, right? So taxable income is only 80. 80 times 25, you got 20. So this is what income tax payable, right? Tax due. And then now we have 0, right? So future deductible amounts. So then this account should be 0 balance. How to make it become 0? So we need to credit 5, right, to this account. And then the last item in the journal is the income tax expenses. That makes sense, everyone? Let me ask you, what for this year, what is the net income? What is net income for this year, 2023? Anyone can tell me what is net income?
25.
Yeah, 75. Yes, you use that pre-tax account income, right? 100, you minus 25, right? So that's how you get net income. Okay. Any question at this moment? So if you look at this deferred tax assets, right, it was 20, right? So now it decreased by 15, decreased by 5, now it becomes 0, okay, after 3 years. Again, that shows you this is a temporary differences only. Okay. So deferred tax assets. That makes sense, everyone? So
we follow these 4 steps every single time.
Yes. You want to follow the way, as every example, we follow the same method, right? So you follow that method step by step. Okay. So then you won't make mistake. Okay. So this chapter is hard chapter because why? Because you're dealing with a lot of different situations, right? So you need to understand those situations first. That make it a little hard. Okay. But the easy part is what? You just follow the same pattern, right? Same rules, okay? And then you have you always have the similar journals like this, right? So the journal will be very similar, okay? Like this. Okay. Okay. So then this is another additional issue to this deferred tax assets. We call the valuation allowance. So valuation allowance is what? Is like just like a accounts receivable. Okay. Remember accounts receivable? We have this called the allowance accounts. Remember that allowance accounts. Okay. For the accounts receivable. So this allowance account is a control accounts receivable accounts, right? So accounts receivable minus the allowance, you can get the net realizable value. Okay. Net realizable value of accounts receivable. Remember that, right? So accounts receivable, not all of those will be collectible. Okay, some parts going to be uncollectible. That's why we need to estimate, right? We need to predict, okay, what are those potential uncollectible amounts? That will be the allowance, right? So we subtract the allowance, then the remaining part going to be the net value of our accounts receivable. Makes sense, right? So remember that, right? So accounts receivable. So in this case, remember accounts receivable is one of the assets, right? So in this case, what is the assets? The deferred tax assets, right? The deferred, we just talked about that special accounts, right? Deferred tax assets based on the future deductible amounts, right? So deferred tax asset is also just like the accounts receivable, okay? We could have those called allowance, okay? Situation, because sometimes some part of deferred assets will not be realizable. okay, will not be realized. Okay, so then you want to estimate those allowance. Okay, we call that valuation allowance. And then valuation allowance is a contra deferred tax asset accounts. Okay, you need to subtract. Okay. So let's look at this example. This company reported pre-tax accounting income in 2016, 17, 18 of this 80 million, 115, 105. Okay, so those are 3 years. Okay, pre-tax accounting income, and then income statement doesn't 2016, the initial year, right, does not include 20 million of magazine subscription received that year. Okay, so remember that 20 millions received that year is money we receive in advance, right? So again, it's just similar to the example we had, we just talked about. So when you receive it, you debit cash, you credit deferred revenues, right? So you don't recognize the revenue. That's why you won't report that items in 2016, right? So, but you need to recognize what you need to pay tax on that. That should be included, right? Should be included in your taxable income. Okay, that makes what makes taxable income greater than accounting income, right? In the year of 2016. Okay, so that's how we get those called deferred tax assets. Okay, that 20 times 40%, let's say, right? 20 times, the difference is 20, right? 20 times 40%. So you have this deferred tax assets. Right? You have this deferred tax assets, 20 times 40%, which is 8, right? Which is 8. Okay, so you have this 8 here. And then, of course, you're going to debit, right? Debit 8, right, to deferred tax assets. You credit the income tax payable based on, for the 2016 income tax payable should be what? Should be 100, right? So that 80 plus 20, right? Should be 100. And then you times what? You times 40%, right? So then you got what? You got 40, right? So then the balance should be the income tax expenses. Okay, that's for the year 2016. Okay. So this is just like the previous example, okay? But we have special issues here, right? So now with this 8 deferred tax assets, okay, you have that journals. So 8 here. So if we believe, okay, management determined that it's more likely than not that 3 millions of the deferred tax assets ultimately will not be realized. Okay, so at the end of 2016, manager needs to predict. Okay, so we said, 8 millions. We said we have that future benefit, but we may not be able to realize that the whole future benefit. Okay, that's 3 millions may not be realized. Okay, you can only realize 5 millions. Okay, so then what are we gonna do? So we need to recognize this. We need to write special journals. Okay, this is just adjusting journal. We recognize that allowance. Okay, and then we debit income tax expenses. So this is just like additional journals, right, to the journals we had. Okay, so with this journal, we create that valuation allowance. Now, valuation allowance is a contra deferred tax asset accounts. Okay, so deferred tax assets will be reported at 8, right? So this is deferred tax assets we talk about, right? So then you minus valuation allowance. So then net value of deferred tax assets should be the 5 in the year of 2016. Okay, remember valuation allowance is our prediction. Okay, is our prediction. Okay, this is just like accounts receivable allowance for accounts receivable situation for 2016. Okay, and then let's say next year, in year 2017, next year, right? By the end of next year, it said the company said remember we believe 3 millions will be ultimately not be realized, right? So now by the end of 2017, we believe, it's not 3 million, it's actually it's a half millions, okay, will not be realized. So again, this is we changed our prediction, right? So then you just make adjustment, right? So when you change our prediction, valuation allowance was 3, right? Okay, before the change, right? Now it should be 0.5, okay, $500,000. So how to make it become $500,000? So you need to, in this case, what? You need to debit, right, 2.5, okay, to decrease that valuation allowance to 0.5. So you debit valuation allowance. What are you gonna credit? You credit income tax expense, okay? Remember, income tax expense is always the last items, right, when you write the journals. Okay, wait.
And when is this situation happen?
It happens is when the managers, managers need to predict, okay? So if you have some chance, that you won't be able to realize the whole tax benefits, okay?
So
Manager needs to make prediction.
in case that the tax law change?
Yeah, it could be, and it could be, let's say, we believe, the company probably, remember, you're gonna get the tax benefit when you make profit, okay? Then you can deduct. What if you won't be able to make profit, right? So that's why you won't be able to deduct. Okay, so there are several different situations. Okay, so that's the you need to consider as a manager. You want to consider those situations to predict: are we able to take advantage fully of that deferred tax assets? Okay, so in this case, we believe some of the benefits will not be able to be realized.
So like
adjustment. Yes.
A magazine subscription, people might cancel and you have to pay them back.
That could be, another factors. Yeah. Okay. Okay. Any other questions at this moment?
I have a question, but from the previous slides, that
Okay.
how did you get 8 million on the
8 million.
asset?
The one, 8 million. I put it here, right? So remember, how to get this 8 is because what? Because we have this 20. 20 is the differences, right?
Mm-hmm.
Okay, it's a future deductible amounts, and 20 times 40%. That's how we got the 8. It's 8. Okay.
Oh, okay.
Yeah. Okay.
All right, got it.
Okay, I think that's all for today. So make sure you do your homework. Okay, make sure you practice, and then we're gonna talk about more. So we're done with the basic. Okay, so the two situation, right? Deferred tax asset, deferred tax liability, and then we're gonna work on the permanent differences. And next time we're gonna work on what is what we have different rate, right? What if we have multiple situations? Okay, so where's that? Yeah, multiple situations. Okay, what are we gonna do next time? We're gonna make more complicated situation. Okay, so make sure you practice those basic the two situation. Okay. And then always, if you have questions, make sure you join us, on Wednesday morning from 9 to 10 o'clock. Go to Canvas announcement. We have a different link. Okay, you click on the link. And that's all for today. See you guys.
When do we have an exam?
Look at the syllabus. Okay. Yeah, check the syllabus. Syllabus online. Yeah.
I have a really quick question about the Excel. I missed the last class, so if I follow the format of the student example, I should be fine, right?
Wait.
What? Hello?